Hey fellow snackers, welcome to another episode of Snackable Wealth. You'll probably notice that the area behind me is different. That is because I am actually at my rental property right now. I had to come and check up on it as I need to clean it and get it ready for a new tenant. I am also going to be making another video with a tour of the place so you guys can see the rental unit. I'll go over some things like how much I paid for it, what it's worth now, the costs associated, and some rental tips and tricks. So if you are interested in that video, I'll post it along with a link in this description. So go check that out if you're interested in that. So moving on, in part one of the option series, I discussed what options are, how they work. I talked about calls, puts, expiration dates, and we talked about time decay or theta. Now we're going to expand on this knowledge so you can start to apply these strategies yourself and hopefully make some extra money in your portfolios. Today, we're solely going to focus on the covered call strategy, which may be one of the more basic option strategies, but it's one of my favorites. It's simple, it's easy, it works, and there's not a lot of headaches with it. So make sure you grab some snacks and let's go. As I mentioned in part one, a lot of people do associate options with gambling. And although buying call options can be associated with gambling, and that is true, selling covered calls on positions that you already have is actually the opposite of gambling. In fact, covered calls actually give you a house edge. They're actually better than just buying a stock outright. So you do get a house advantage on that. It's a little bit like being your own casino, which is very helpful. Covered calls allow you to get paid just for holding stocks that you already own. They can reduce your risk and they can even get you out of some sticky situations if your trade starts going sour. They can help you repair those trades. Once again, covered calls may be one of the most boring option strategies out there, but they work. And that's what we're here for. We're here to learn about option strategies and solutions that are going to work and make you money. There are a lot of complex option strategies out there, and to be honest with you, I do not use 90% of them because they just suck, all right? Covered calls are basic, but they help you maneuver the markets, they help put money in your pocket, and most importantly, they help you to get more gains and a higher return on your money. In essence, a covered call is very simple. At its core, all you're doing is selling a call against a security or shares that you already own. In doing so, when you sell that call, you collect a premium right away up front. That's money that goes directly into your pocket. All you're doing is you're agreeing to sell your shares at a set price on a certain date. You're not predicting anything with covered calls. All you're doing is setting a price that you would be happy selling your shares at and collecting a premium for that. And remember that because each option is for 100 shares, you would need to hold at least 100 shares for every one contract or for every one covered call that you sell. If you've got 500 shares, then you can sell 5 options contracts or you could sell 5 covered calls. And this brings us to why it's called a covered call in the first place. The reason it's a covered call is because you already own the asset, which means if you owe someone that asset at a set date in the future, well, you've already owned that. So you can go ahead and cover your debt. And that is why it's called a covered call. Now, there is a way that you can sell options that are not covered. Selling uncovered options are referred to as naked options. Now, although these can be done, they are extremely risky. They carry high levels and sometimes unlimited levels of risk. Now, we will get into that in a future video, but for now, let's focus on the covered call strategy. Now, let's say you come across this brand new company that everyone is talking about online called Snackable Wealth. Okay, you saw on Wall Street Bets that some guys got a thesis going, and you know what? You're too lazy to do your own DD, so you just take his word for it. After a few moments of consideration, you think it might be a good idea to buy some shares of Snackable Wealth. So, what do? You go ahead, you buy those shares because you think Snackable Wealth has deep fucking value and you like the stock, right? So naturally, let's say you buy 100 shares of Snackable Wealth at $50 per share. However, let's say that you no longer believe that Snackable Wealth would be a great value play after a 10% rise in the share price, which would be $55. So what do? Simple. You would sell a call with a strike price of $55. Now let's assume that you sell a call on your Snackable Wealth shares at a $55 strike for 1 month into the future. And you can collect a premium of $1 for those options. This means you will get $100 immediately into your account as soon as you sell that option for a $55 strike 1 month into the future. Now, two things can happen here. So in the first scenario, let's say that the stock does not go over $55. Well, in that case, you get to keep your shares and you also get to keep the $100 that you collected for selling those covered calls in the first place. In scenario 2 though, let's say that the stock does go over $55. In that case, you would then sell your shares to that person at $55 and you get to keep that $100 that they paid to you initially, making your profit $600. If you had have just sold those shares at $55 without selling that covered call, you would have only made $500. So you actually increased your profit by an extra $100 by selling that covered call. Now, neither of these scenarios are a complete disaster, and that's exactly why covered calls are an investing strategy and not a YOLO strategy. In the first scenario, you still have your shares, but you collected $100. And in the second scenario, you lost your shares, but you got to collect $600 in profits, right? Seems like a win-win in both scenarios, if you ask me. In fact, in scenario 1, you could actually repeat this process and just sell calls again for the next month. So if you went ahead and sold calls at a $55 strike for 1 month out, you would have collected that $100. Now you can do the exact same thing and sell another call for the following month and probably collect another $100. Options quite literally give you options. Let's take a look at some other scenarios and some strategies that you can employ if the stock does not go over the strike price of $55. Scenario 1, which I already explained, let's say the stock hasn't moved, okay? Snackable Wealth is still $50 a share. You still think that $55 is a good exit price, so you just go ahead, you sell another option for 1 month out, you collect another $100. Bingo. Easy. Scenario 2. Let's say that the stock didn't go above $55, but now it is $53 at the expiration date. You still think that a good exit price is $55. Well, now what you can do is you can sell a $55 strike out to the next month again, but because the stock has gone from $50 to $53, that risk premium is higher. So what you can actually do is you can collect $200 instead of the $100 that you were collecting before. Scenario number 3. So just like scenario 2, let's say that the stock did not go over $55, but it's sitting at a $53 per share price right now. Now, our initial thesis was that $55 was a good exit, but the more you read on Wall Street Bets, you keep hearing about how this stock might actually hit $60. Well, what you can do is you can actually follow that stock upwards. Instead of selling a $55 strike, you can now sell a $58 strike for the next month. This would net you $100 in premium again, but instead of selling it at 55, you would be able to sell that stock up to $58. So you're leaving your upside open. You're just following the stock as it continues to rise and collecting premium as you do that. Now let's look at scenario 4, because this is where things start to get a little different here. Let's say that that guy on Wall Street Bets, his thesis was completely wrong. You should have done your own DD, but you're lazy and you didn't. So now the stock is $48. Well, what can you do? You can diamond hand it and you could just sell another $55 strike for the following month. The kicker is that because the stock went down from 50 to 48, the risk premium has dropped as well. You can no longer collect $100. You can only collect $50. But that is still an option if you think that the stock is going to go up to 55. You can just sell another $55 call and collect that $50 and move on. So far in these 4 scenarios, we've only been selling covered calls with a strike price that is above the current stock price. These are known as out of the money or OTM calls because that strike price is above the current market price. In these next scenarios, they're going to look a little different. Scenario 5, the stock is $47. You've lost $300. You're getting scared. It turns out that not only does Snackable Wealth not have deep fucking value, but you're a paper-handed bitch and you're just praying to the market gods to just give you your money back and you'll never do this ever again. So, how do we fix this scenario so that you don't have to tell your girlfriend's boyfriend that you didn't have money to feed her before he comes and picks her up later? You can sell a 30-day $47 call. Yes, that is selling a call at a strike price at which the current stock is already trading at. This is known as selling an at the money or ATM option for short. When you sell an at the money option, they will always pay the highest amount of premium because they have the most risk associated with it. So in this example, because the risk premium is so high because we're selling an at the money call at a $47 strike, the premium you can collect is actually $300, right? Now 47 plus 3 is 50, which is exactly what you paid for the stock in the first place. And if this is the next month here, we've already collected $100 from our first month. So all we need is for Snackable Wealth to stay above $47, and we actually still come out with a $100 profit, even though Snackable Wealth fell by about 6%. Honestly, that's not bad. If you can still make 2% after the stock has fallen 6%, you're definitely doing something right. Okay, last scenario. This is where things really start to lose grip. Snackable Wealth has fallen to $45 now. The girlfriend, she left you completely and she took the dog. Your fridge, it only has condiments left in it. We need some damage control here. You know you can't afford to sell at a $500 loss, but you are willing to sell the stock at a slight loss because, I mean, it should bounce a little after falling 10%, right? I mean, usually that's the case, but not always. So you can sell a 30-day call option at a strike price of $40 per share. That's $5 whole below the current price. Now, selling this option has both intrinsic and extrinsic value. So you're going to get paid $7 in premium for this. Okay? The intrinsic value is the difference between 40 and 45, which would be $5, and your extrinsic value would be the $2 on the outside, making your premium that you collect a full $7. This gives you a ton of downside protection. The stock has already fallen from 50 to 45 and it's lost 10%. Now, the stock would have to fall 12.5% more and you would still be able to get out of this position at only a $300 loss, because if the stock ends at expiration above $40, then you sell your shares at 40, but you've collected $7 in premium. Now, because we also collected $100 in premium from the month before, that actually puts us at a selling price of 48. Effectively, we rode that stock from $50 all the way down to $45 or even less, but we got out at 48 for only a $200 loss. Because we sold a call option at $40 while the current stock price was $45, Okay, our strike price is below the current market price. This is known as selling an in the money or ITM call for short. You can see here that there are many different ways that you can play around with covered calls. There's a lot of situations where you can sort of adapt and move things around in order to change your level of risk tolerance depending on how the market changes as well. So sometimes you may be very bullish and you may want to sell out of the money calls that are far out. Other times you may end up getting scared and you just want to get out of the position, but you want to pull a little bit more money back in. There's a lot of different methods that you can use with this strategy to either increase or reduce risk and either increase profits or just get out of the trade completely. One thing, just to be clear, is it's important to note that just because the stock goes over your strike price does not mean that your shares are going to be called away. Most of the time, and I mean like 99% of the time, your shares will go all the way until expiration. So most of the time, it's okay for the stock to go above the strike price because it's likely that your shares are not going to be called away unless the stock is over the strike price at the expiration date. But beware, the buyer of that call option does always have the right to call away your shares at any time before and including the expiry date. When you sell a covered call, effectively you are selling upside potential to the buyer, and you're selling that upside potential and capping it at a certain price. Not only that, but you are actually reducing your risk. And you're doing that by collecting money up front, which is something that you wouldn't get if you were just buying the stock and then selling the stock. You're basically saying, hey, if this stock goes parabolic and crazy and goes to the moon, I'm okay with missing out as long as I can collect some money up front. You're trading maximum upside potential for guaranteed income today. Covered calls will not make you rich fast, but they are a way to guarantee income and get your portfolio working harder for you while you just sit around and wait. And as I said before, they can also reduce the magnitude of losses if you accidentally enter a trade that goes sour or against you. So how does this fit long-term investing? Well, long-term investors, they already own shares, right? They sit through boring months. They watch the price bounce around and sometimes it goes sideways and it does nothing. But covered calls, they can turn that boredom into cash flow, into money in your hand. Instead of just sitting around hoping that your stock goes up, be proactive. Do something about it. Make sure you're getting paid for waiting. Make sure you're getting paid for that patience. This strategy is especially useful for sideways markets, for large companies that don't really move that much or aren't as volatile. And of course, it's extremely good strategy to use if you have a stock that you wouldn't mind selling. Maybe a stock that you think might be getting a little too high. That's a great opportunity to sell a covered call on it. Covered calls absolutely love boring, flat, and slow markets. And you know who hates those type of markets? Traders. Now, covered calls are not magic, right? Remember that you are selling upside potential, so they do come with some risks. Because covered calls cap your upside, if the stock does explode, you're going to miss out on some of the gains. Also, you do have to own the downside. The premium that you collect, although it will reduce your loss, it's not going to save you. If that stock falls 10%, it's going to hurt. Also, assignments will happen. There is going to be a point in time where your shares do get called away and you may lose a little bit of upside potential and lose your shares. But you know what? Having your shares called away, in my mind, that's a win. You set your price that you wanted to sell, you collected premium for that, now your shares are gone, but hey, that means you made money. So don't worry about the fact that you may have lost some potential upside. You made profit. And that's not a failure. That's the strategy working for you. Covered calls don't eliminate risk, but they do reshape that risk. And you can mold that risk in many different ways, as I've shown you in those scenarios before. Covered calls are for people that already own positions. They don't need excitement. They're okay with selling at a certain price, and they want guaranteed income. But they absolutely are not for anyone who is chasing maximum upside potential, and they're not for anyone who panics during dips. If giving away your stock to someone else is going to make you emotional, or you're going to be upset about losing your shares, then do not sell a covered call. One simple rule is to make sure you only sell covered calls on shares that you wouldn't mind getting rid of. A quick Canadian specific note here is that, in my opinion, covered calls do not belong inside tax-free savings accounts. Although it's unlikely, if the CRA deems that you are trading within your tax-free savings account, that can cause tax implications. Not only that, but you don't want to cap your upside potential in a tax-free account. I would only recommend doing options in a non-registered or a margin account, because that's how I personally do it, and I think that's the way it should be done. You should be saving your RRSPs and TFSAs and all registered accounts in just slow, boring, long-term investments, and you shouldn't really be playing around with those. Now you've seen how you can get paid to hold stocks you already own, how covered calls can help you to fix broken trades, as well as different scenarios in where covered calls can help you navigate the current waves of the market. In part 3 of this series, we're going to completely flip it. Instead of talking about how you can get paid for stocks you already own, we're going to talk about cash secured puts. And cash secured puts allow you to get paid for stocks that you do not own yet. Covered calls pay you when you already hold stocks, but cash secured puts are going to pay you to buy stocks that you want to own. Now, if you put those two strategies together, that's one hell of an option strategy. If this video has helped you in any way, or you thought it was informative, please hit that like button and subscribe to the channel. It does help me immensely as a content creator, and it helps grow the channel so that other people can see it and they can learn as well. As always, if you have any questions, if there's anything you're unclear on, please drop a comment, ask me. I will sort everything out for you so that you understand perfectly. Thank you for watching Snackable Wealth, where I provide you with blunt and honest Canadian money talk. Go watch that tour of my rental property, and I will see you guys next time in the option series part 3.